Sarah, Sheila, what are you guys doing?
Actually, we want to invest on something but we don't know how to do it.
Yeah, we are so stressed. I can see you guys have a lot of money.
Right.
It's okay, Sheila. We study investment, so we can help you.
Oh, how can you guys help us? Wait, I have one video to share to you guys, so you guys can take a look at it together.
Investment is a simple idea. It means giving up something you could spend now so you can have more consumption or a greater return in the future. Your money goes into two main kinds of assets. Financial assets are claims or documents. They are easy to buy and sell. We call this high liquidity, but you must use a broker to access the market. While real assets are tangible physical things that generate income. You own something real and valuable. The challenge is selling them quickly as there isn't an efficient market for short notice sales. Next, we all invest for two big reasons. Personal goals are about security for your life, having insurance, saving for a home, and funding education for your children. While financial goals are about making your money work hard. These include keeping the original value of your investment safe, protecting your money against inflation, and lastly, ensuring liquidity. Finally, we look at risk and return. Risk is the chance that the money you actually get back will be different from what you expected. The rule is simple. Risk and return have a positive relationship. The higher the risk you are willing to take, the higher the return you should expect. Thank you.
For the primary and secondary markets, support the investment process. First, we look at the primary market is where new securities are created like IPOs and new bonds. Investors buy directly from the issuer and this provides fresh capital for companies. For the secondary market is where investors buy and sell existing securities with each other. This market provides liquidity and helps determine daily prices through supply and demand, making it easy for investors to enter or exit. Both markets work together. The primary market supplies new instruments for future trading. The secondary market boosts confidence because investors know they can sell their securities anytime. In summary, primary means pre-sales and new cash, secondary means reselling at real price.
Here is a real example of a primary market activity from Bursa Malaysia. This is the IPO timetable for Polymer Link Holding Berhad. In this process, the company issues new shares for the first time to raise fresh capital. Investors submit their applications directly to the issuer during the offer period, which is shown here from 4 to 11 November 2025. After that, the balloting takes place on 13 November to select successful applicants, followed by the allotment of IPO shares on 21st November. The company is then scheduled to be listed on 25 November 2025. This section shows the daily trading activity, including the most active counters, the top gainers, and the top losers. These prices represents transactions that are happening between investors who are buying and selling existing shares, not new issues. This is exactly what defines the secondary market. Once a company is listed, its shares move into this market where trading occurs freely based on supply and demand. Through continuous buying and selling, the market provides liquidity, meaning investors can easily enter or exit their positions.
Moving on to the investment in real asset. They are related to physical or tangible asset that contrast with financial asset. Firstly, real estate, or basically known as property asset. As an example, houses, buildings, and lands. Real estate tend to see value appreciation and can generate income through rent. It is safe and secure in return to invest. However, it demands large initial capital and the buying or selling process is often slow and tedious. Next, collectibles such as drawing, old coins, and limited edition shoes. This unique item can see their values skyrocket in the market if demand is high. They are also protected by insurance. It is a very liquid market, meaning it's hard to sell quickly. This asset also requires special skills and expertise, and this investment need of networking contact to sell them. Lastly, gold. For instance, jewelries, gold coin, and others. Gold is excellent as hedge against inflation, protecting purchasing power during economic uncertainty. The key limitation is that gold does not provide a steady income like dividend or rents. Its price is also highly sensitive to market sentiment and global news, and it required special knowledge.
Next, I will explain about investment in financial assets. First, securities investment. In the example, T-bills. It have no risk because they are usually issued by the government. However, the downside is that the interest rate is relatively low. Second, saving investment. In example, fixed deposits. They also carry low risk and are suitable for medium-term saving. But if we withdraw before the maturity, we will not receive any interest. Third, unit trust funds. For example, Amanah Saham Nationals. They offer stable and consistent dividend returns. However, investors do not have any voting right in the fund management. And lastly, derivative securities. For example, futures can be a good hedge against inflation, but they come with high risk and require a higher capital. In conclusion, each investment instrument has its own advantage and disadvantages. So, we should choose based on our risk level and financial goals.
Yay!